this chapter, we continue to look at the income statement and the statement of cash flows and how they are integrated and what they can tell you. So some of the things that this chapter is reinforcing is what revenue is and what are the criteria that permit us to recognize revenue. Looking at how cost of goods sold is determined under both the perpetual and the periodic inventory accounting system. This impacts your decisions. Talking about gross profit and the gross profit ratio. Identifying principal categories and components of other operating expenses and how we report those on the income statement. Look at what income from operations is and why this amount is significant to managers and financial analysts. Talk about the components of earnings per shares calculation and discuss the reasons for some of the refinements that are made in that calculation. Compare and contrast the alternative income statement presentation modules. Talk about the meaning and significance of the unusual or infrequently occurring items that may appear on income statements. Talk about the purpose and outline the general format of the statement of cash flows. We're going to illustrate the difference between the direct and indirect methods of presenting cash flows from operating activities. And summarize why the statement of cash flows is significant to financial analysts and investors. So to get started, we talk about revenue. Revenue is generated when a firm sells a product or provides a service to a client or customer and receives cash, creates an account receivable, or satisfies an obligation. So when we think about this, what this says is that we are providing something and that whatever that is has been maybe not 100% provided, but has been provided almost completely. So you don't absolutely have to hit 100% before revenue is recognized. Revenue is going to be measured by the amount of cash that's received or expected to be received from the transaction. How much consideration are we expecting? That's how we measure revenue. So there are a couple of different terms when it comes to revenue. There is revenue is realized when the product or service has been exchanged for cash, claims to cash, or an asset that is readily convertible to a known amount of cash. So when it is realized, there is a consideration that has been received of some type. Versus when it's earned, that's when we have substantially completed something, the activities to perform left to be performed for the revenue are minimal, so it is substantially complete. If it has been earned, then we should recognize our revenue. We are entitled to that amount of consideration. We are entitled to the benefits of that revenue. Companies should disclose any unusual revenue recognition methods, such as a percentage of completion or installment method, and you'll often find this in the notes to the financial statements. Things such as installment or percentage of completion methods rely to large projects, construction, manufacturing, things of that nature. So let's take a look at sales revenue. Here we have Matrix Incorporated, who sold inventory on account to a customer in the ordinary course of business. You'll see that they would debit or they would debit cash or accounts receivable for the amount of what that sale is. Now, by and large, this is not the only situations that occur. We don't just make sales in the course of business, and we don't just perform services. There are other intricacies that come into play, kind of important things that we as managers or accountants need to take into consideration. And that is that sales often are accompanied by things such as returns. So this is when the customer brings product back. That can be for any number of reasons. Could have been the wrong color, wrong size. Maybe there's some type of a buyback that is written into the contract with the customer. Could have been dented by the carrier. There's a lot of reasons why merchandise can come back, and that can come back to either the manufacturer or merchandiser. So we need to take into account that there's going to be some percentage that will be returned. Now that percentage is usually determined as a base of sales as the result of a historical experience model. Additionally, what can happen, and this happens oftentimes if you think about Lowe's or Home Depot, and you go in and they have this area of appliances or fixtures that are scratch and dent. When those were delivered to Lowe's or Home Depot, they were damaged in delivery, so there was a scratch or something got broken. What the manufacturer said to them is that we don't want to pay necessarily to have that brought back. How about we knock a certain amount off the price and you keep it? You keep the defective merchandise and we'll just discount it. We'll provide you a sales allowance. This is a reduction in the amount owed by the customer because of the defective merchandise. This, again, is a normal risk of business. This is something that's going to happen. With that in mind, then we're using a historical experience model. We ascertain based off sales what we need to post for that. Remember, we're trying to look for what the net sales, the true sales are, the true revenue that will be recognized in this specific period. And then sales discounts. Those are our terms. Those are 210 and 30. These are reductions in amounts that are owed by the customers to encourage prompt payment on the account. If we're using the gross method with sales, then of course you're going to have a sales discounts line to reduce that to what we expect our net sales amounts would be. Now with shipping terms, these are often designated FOB. Our shipping terms determine ownership of merchandise. Ownership transfers to the buyer when merchandise is passed to the carrier using FOB shipping point, and the buyer pays the shipping costs. Now this may be that the buyer is paying the shipping costs on the invoice and remitting them to the seller, but they are the person paying for the shipping costs. With FOB destination, ownership transfers to the buyer when the merchandise is transferred or passed to the buyer, and the seller is paying the shipping costs. These are just some basic terms that you should have some awareness of. Because they do impact inventory and what is or is not your legal assets at the point of an inventory. So speaking of the different inventory systems, you should recall that there are two. There's the perpetual and then there's the periodic. In a perpetual inventory system, cost of goods sold is determined every time a sale is made. This has been enhanced with the use of technology over the years, barcode scanners and computers. It is more frequently used now than it was in the past because it is aided by computers and technology. However, when using the periodic inventory system, cost of goods sold must be calculated differently. It's calculated at the end of the period. We begin with the gross purchases. So we have our beginning inventory, and then we have this purchases account, and that purchases account is where we post everything that we have purchased through that given period of time. Then we will subtract any purchase discounts and purchase returns and allowances to determine what our actual net purchases are. We add in freight in to those net purchases and add that to beginning inventory. That gives us the total amount of cost of goods that were available for sale for that period. Now, what has also gone on is that somebody has gone out and they have counted the inventory and they have ascertained what the ending inventory value is. We subtract that because that's still here, and we determined that we moved or had cost of goods sold of $351,800 in this specific period. Under the perpetual system, a record is made for every purchase and every sale, and it is a continuous record of the quantity and cost of each item that is maintained. When an item is sold, its cost, as determined utilizing one of the cost flow assumptions, is transferred from the inventory asset to the cost of goods sold expense. Now, this is something that is not historically been the most popular method of inventory system, because think about the vast quantity of items, even in a small rural town that has a little bitty grocery store in it. Just imagine the amount of items that they had in there and trying to keep track of each and every one. So what they would do is they would use the periodic inventory system to back themselves into their cost of goods sold, because it was much more time effective. Think about that cost constraint, and the benefit of providing the information must exceed the cost of providing that information. Now that we have scads of computer systems and we have point of sale systems that interface with our accounting systems, we're seeing more and more of a perpetual system come into play. Now, I think you're probably wondering, why did you get a bit of a reminder about what revenue is, what cost of goods sold are? This is because they are factors of gross profit. Gross profit is something that as a manager you need to always take into consideration. It's the excess of sales over your cost of goods sold. It represents on the income statement is sales minus cost of goods sold. And the ratio equals gross profit divided by net sales. This is what you have available to your organization to cover all the operating expenses before yielding a net income. And there are a lot of things that impact this. One is your actual cost of goods sold. Now remember, that is direct materials, direct labor, and the overhead component. Amongst that, if you are not yielding a gross profit that is equal to an amount that can cover what you need for your operating expenses and yield the targeted net income, then you need to make adjustments where you can. Now, those adjustments can be in those elements of overhead, or maybe you look at what direct materials and direct labor costs and see what you can do to lower those, or you set the selling price at a different amount. So let's look at that with Matrix. Matrix purchases a product for resale at a cost of $70 per unit. The company desires to earn a gross profit rate of 30% on all sales. So what is the selling price per unit? To calculate this, we divide the cost of the product by 1 minus the gross profit rate. The selling price equals 70 divided by 1 minus 0.30. So the selling price equals $100 per unit. Now, the question you would have at this exact point is, can you actually sell this particular item at $100 per unit? If you cannot, then you may have to go back to your gross profit ratio and what your desired gross profit ratio is and see what there is that you can do to change that. Depending upon what type of a company you are, you may be able to make an adjustment to your cost of goods sold if you're in a manufacturing environment, where you may have to accept that underneath this particular item, you can't sell it for that much. So you're going to have to accept a lower gross profit ratio for this item. Now, that can be made up as a global gross profit ratio by applying something larger to a different item that can bear that high of a price. So expenses are generally outflows or the using up of assets or the incurrence of liabilities from delivering or producing products, rendering services, or carrying out other activities that constitute an entity's central operations. Some expenses are recognized concurrently with the revenues to which they relate based on the matching principle. Some expenses are recognized in periods in which they are incurred. And some expenses result from the allocation of the cost of an asset to the period. So let's take a little bit of a deeper look at some of our operating expenses. Maybe, my apologies, it skipped a slide there on you. So your operating expenses are going to fall into one of these classifications on your income statement. They're either going to be a selling expense, such as commissions, a general and administrative expense, such as maybe office salaries, or research and development expenses if you are in a manufacturing facility. Remember that these different classifications will group like type expenses together. They may be one-lined on an income statement, such as you see here, but amongst those general and administrative expenses, there are several of them that are part of that $78,500. The multi-step income statement has gross profit calculated before operating expenses and income from operations. Although only an intermediate subtotal on the income statement, income from operations is frequently interpreted as the most appropriate measure of management's ability to utilize the operating assets. So let's just take a quick look. Right here, we have income from operations of $140,100. The components of that are all the things that the managers are using to generate sales. That's what those expense components are. How effective are they at generating this amount of net sales? These other components down here on the bottom are things that are not as controllable by management from a day-to-day basis, such as loss and sale of investments, your interest expense, your gain on sale of plant assets, any interest income. All these are ancillary to central operations. How is management performing its job? Are they doing what we expect them to do? This is illustrated in the income from operations. Now, after income from operations is calculated, Then we take all those other revenues and gains and expenses and losses to arrive at income before taxes. Then we calculate what the income tax expense would be expected to be and subtract that to arrive at net income. And one thing that occurs on the face of every income statement is the earnings per share. Basic earnings per share is calculated by dividing net income, so bottom line, by the average number of shares of common stock that were outstanding during the year. The first thing we have to do is calculate the weighted average number of shares of common stock. We read the assumptions and go through the calculations of the number of shares outstanding for cruisers here. So how you calculate that is it's going to depend. So if the stock doesn't change, right, in the course of the year, it remains the same at the beginning and it remains the same at the end. Not a problem. But to get a weighted average number with stock changing, what we do is we look at for what period were the number of shares outstanding stable. So for 3 months, there were 200,000 shares outstanding. That would give us 600,000 shares. Then for 7 months, from 12/3 to 6/28, we had 240,000 shares that were outstanding. That gave us 1,680,000. Then from 6/28 to 8/31, which is 2 months, there was only 225,000 shares outstanding. Apply that across and it's 450,000. That means that in the course of 12 months, we would have effectively 2,730,000. When we divide that out, that tells us that in essence, the weighted average number of shares for that period is 227,500 shares. It's because we had a period of time when there were quite a bit more outstanding than there were in other periods. This is one of the times when we don't just take beginning of the month and end of, or beginning of the period and end of the period, add them together and divide it by 2 because it's a weighted average number. Once we know the weighted average number of shares outstanding for Cruisers Incorporated, then we start with net income. We reduce net income by any preferred stock dividend requirement. So this does not mean that it actually has to have been declared, but what would it be to determine how much of the net income would be available for common stock owners? Remember, your preferred stock owners will receive their dividends before there is anything available for common stock. So we do an adjustment to net income to ascertain of what was earned, how much is actually available to just the common stockholders. For cruisers, that's $1,247,000. We divide that by the 227,500 weighted average number of shares of common stock that were outstanding to ascertain an earnings per share of $5.48. Now, there are some things that can happen that create an additional calculation of earnings per share that you will find on the face of an income statement. If there are stock options, convertible bonds, or convertible preferred stock, there is the potential for the dilution of a basic earnings per share. When any of these types of securities are present, we test to see if, in fact, there is dilution. When dilution is determined, we report a second earnings per share statistic that is known as the diluted earnings per share. And what this says is it says, based on these other types of securities, such as stock options, convertible bonds, and convertible preferred stock, if they were to have converted into their stated number of common shares, then our earnings per share would have been this. So it's kind of a worst case scenario versus basic earnings per share, which is best case scenario, to say how much of the earnings would potentially be available to a common stockholder. Now, there are two types of income statements. There is the single-step income statement, which subtracts total combined expenses and losses from the combined revenues and gains to ascertain net income. The multiple-step format separates the different components. We have our sales, then we have operations, and then we have other elements. Both arrive at the same bottom line. Net income is net income. The difference is in how we present the information. So with a single-step income statement, for a user to determine income from operations, they may need to have some additional information, or they may need to do independent calculations. Whereas underneath the multiple-step income statement, we already put it out there in front of the user from the onset. Now, in the course of any business, you're going to have some extraordinary things happen. These are our usual or infrequently occurring items, and they will appear on your income statement when they do occur. They can be from discontinued operations, and now that could just be a discontinued plant, that could be a discontinued line, or that can be discontinuing an entire brand. Other types of extraordinary items, such as losses from fire, theft, Mother Nature, and then any non-controlling interest in the earnings of subsidiaries. These are the items that are unusual that will appear on income statements. These items are going to typically be reported net of taxes. So here you can see where the calculation is that there is an income before the extraordinary item. Here is the extraordinary loss net of a tax benefit of $22,500. This means after the benefit is taken into account, and what its overall impact is to net income. In that other section, we find the increases or the gains, or the decreases or the losses in an entity's net assets that resulted from non-operating activities. So gains and losses are usually reported as other income and are excluded from the operating income. On the income statement, gains are reported in the other revenue and gains section, while losses are reported in the other expenses and losses section. Now, this can come from the disposal of plant assets, from the disposal of an investment. Any variety of things can result in a gain or a loss. However, those are going to be non-central operational activities. They're going to be less frequent. So we're going to find them in the other revenues and gains section. Last but not least, we're going to talk about the cash flow statement. So your cash flow statement is a statement which provides all the information about the cash receipts and the cash payments of an organization. This statement shows why your cash and cash equivalents changed during the period by reporting net cash that was provided or used by either your operating activities, your investing activities, or your financing activities. You should remember that that goes all the way back to the beginning of class where we talked about how different activities are deemed by an organization. So within the enterprise, you're going to have three sections. Cash inflows are then netted against the cash outflows to determine what the overall effect is. So cash inflows from operating activities would be things such as cash received from revenues. Investing activities would be the sale of those operational assets. Remember, when you purchase plants, property, and equipment, it's an investing activity. When you sell it, it is also an investing activity. From the sale of investments or the collection of loans. And then financing activities would be things such as the issuance of stocks, bonds, and notes. Cash outflows for operating activities would be things such as the cash that is paid for operating expenses. Investing activities, the purchase of investments, the purchase of operational assets. And financing activities would be things like payments of dividends, repurchase of stock, so purchase of treasury stock, or repayments of debt. With this information, we are able to see how effective a company is managing their cash flow for a given period of time. However, in an income statement, there are some things that occur that really are not cash related. Those are our cost allocations, such as depreciation expense and amortization expense. They don't affect cash, but net income is reduced by these items. We need to remember that when we go into creating our cash flows, that as the result of accrual accounting, there are some things that occur that actually don't affect cash for the period, but they did affect income for the period. Investing activities relate primarily to the purchase and sale of your non-current assets. So you're looking at your long-term assets, such as plants, property, and equipment, and investments, notes payable, things of that nature. Notes receivable, things like that. It's going to be non-current related. Cash is often used in order to acquire or build these types of things during the given year. These are investments. We call them capital additions. Investments in debt or equity securities of other entities are also shown as investing uses. And cash received from the sale of non-current assets is shown as an investing source of cash. The lending of money and the subsequent collection of loans is considered an investing activity as well. So let's look at the statement of cash flows. It can be presented using the direct method. And here we have highlighted cash flows from operating activities. The direct method calculates the cash received and paid for each of the classifications of type of business. A supplemental reconciliation, or an indirect, begins with net income and then it adjusts that net income for those non-cash items like depreciation, the changes in our accounts payable, gains on the sale of land, the increase in accounts receivable, increases in inventory, to ascertain at the same amount of cash flow from operations. The direct method is the method that is preferred by GAAP. However, a lot of people find that the supplemental reconciliation, which reconciles net income back to net cash flow from operations, as more useful as a tool. Here we have the rest of the indirect presentation. So we started with net income. And we had that reconciliation to net cash flow from operations. Then we have cash flow from investing and financing activities, and that is literally exactly the same as it is underneath the direct method. Approximately 99% of major corporations use the indirect method of presentation, even though the direct method is the one the GAAP says is preferred. You can choose to use either. They just like the other one better. Some of the things that you will do is you will look at the statement of cash flows and determine where the cash has been coming from. If an entity does not generate cash in their operating activities section for a significant portion of time, they are obviously probably looking to outside parties to fund their day-to-day activities. And as that continues to go on, they will overextend themselves. This may actually be normal depending on where an entity is in a strategic position. If an entity is heavily growing, they may not have positive cash flows from operations as they are consuming a lot of it with this new operations, and they may be financing that with bonds or equities because they're going to continue to be investing in new PP&E and things of that nature as they move into, say, maybe a European market. As they get their foothold in that market, though, we want to see that cash flow flip to be more from operating activities and less from financing activities. There's no right or wrong necessarily presentation that we're expecting to see because it is very dependent upon where your organization is and what they are doing and what this will tell us.